Canada's banking rate, a cornerstone of the economy. It's more than just a number. It's a fundamental driver of economic activity. Set by the Bank of Canada, this rate acts as a benchmark for lending rates across the country, influencing everything from mortgages and business loans to consumer spending and overall economic growth. Understanding the banking rate is key to grasping the dynamics of the Canadian economy. It acts as a lever, controlling the flow of money through the financial system. When the Bank of Canada raises the rate, borrowing becomes more expensive, which can curb inflation by slowing down spending. Conversely, lowering the rate makes borrowing cheaper, stimulating economic activity by encouraging businesses to invest and consumers to spend. The Bank of Canada carefully monitors economic indicators, adjusting the banking rate to maintain stability and promote sustainable growth. Its decisions are based on a complex analysis of factors such as inflation, employment levels, and global economic conditions. These decisions have a ripple effect throughout the economy, impacting the lives of everyday Canadians. The current economic climate is marked by uncertainty, with global events and inflationary pressures weighing on the Canadian economy. The Bank of Canada's response to these challenges will have significant implications for borrowers, investors, and the housing market. Understanding the dynamics of the banking rate is crucial for navigating the economic landscape in the coming years. The year 2024 is poised to be a pivotal one for Canada's prime rate. Economists and market analysts are anticipating cuts to the prime rate, a move that could have far-reaching consequences for borrowers and the housing market. These projections are rooted in current economic conditions, including moderating inflation and a potential slowdown in economic growth. While the exact timing and magnitude of the rate cuts remain uncertain, experts suggest that they could begin as early as the latter half of 2024. These cuts are expected to be gradual, with the Bank of Canada carefully assessing the impact of each adjustment. The central bank's cautious approach aims to strike a balance between stimulating economic activity and keeping inflation in check. The anticipated rate cuts are driven by a confluence of factors. Moderating inflation, a potential slowdown in economic growth, and global economic uncertainties are all contributing to the Bank of Canada's inclination towards a more accommodative monetary policy. Lowering the prime rate is seen as a way to provide some relief to borrowers and encourage economic activity. However, the Bank of Canada will be closely monitoring the effects of these rate cuts. The central bank's primary mandate is to maintain price stability, and it will be vigilant in preventing inflation from resurging. The pace and extent of the rate cuts will be dictated by the evolving economic landscape, with the Bank of Canada constantly adjusting its course based on the latest data and projections. For mortgage holders, the anticipated prime rate cuts could provide welcome relief. Lower rates translate into lower monthly mortgage payments, freeing up cash flow for other expenses. This could be particularly beneficial for those with variable rate mortgages, which are directly impacted by changes in the prime rate. The extent of the savings will depend on the size of the rate cuts and the terms of the individual mortgage. However, even a small reduction in the prime rate can result in noticeable savings over the life of a mortgage. This extra financial flexibility could allow homeowners to pay down debt faster, save for the future, or increase their discretionary spending. The impact of rate cuts extends beyond individual budgets. Lower mortgage rates can stimulate the housing market by making homeownership more affordable. This can lead to increased demand, potentially driving up home prices. However, the overall effect on the housing market is complex and depends on a variety of factors, including supply and demand dynamics. It's important to note that while lower rates can provide benefits, they also come with potential risks. Lower rates can fuel borrowing and spending, potentially leading to higher inflation down the line. Additionally, a sudden increase in demand for housing can exacerbate affordability challenges, particularly in hot real estate markets. Section 4. A shifting landscape, rate cuts, and the Canadian housing market. The Canadian housing market is intricately linked to interest rates. Prime rate cuts can have a profound impact on the dynamics of supply and demand, influencing home prices, sales activity, and affordability. Understanding this interplay is crucial for both buyers and sellers navigating the market in a changing rate environment. Lower interest rates can stimulate demand by making mortgages more affordable. This can lead to increased competition among buyers, potentially driving up home prices. The extent of this impact will vary depending on local market conditions, with already hot markets potentially seeing a more pronounced surge in prices. On the supply side, lower rates can encourage developers to build more homes. The prospect of increased demand and higher prices can incentivize construction activity. However, supply chain issues, labor shortages, and regulatory hurdles can dampen the responsiveness of supply to changes in interest rates. The overall impact of rate cuts on the housing market is complex and multifaceted. While lower rates can boost affordability and stimulate demand, they can also exacerbate affordability challenges in certain markets. Additionally, the interplay between demand, supply, and interest rates can create volatility and uncertainty in the market. Section 5. Timing the market investment strategies in a changing rate environment. Navigating the housing market in a period of fluctuating interest rates requires careful consideration of investment strategies. Timing the market is crucial, as buying or selling at the right moment can significantly impact returns. Analyzing market trends, economic indicators, and individual financial goals is essential for making informed decisions. For potential homebuyers, lower interest rates can present an opportunity to enter the market at a more affordable price. However, it's crucial to assess affordability based on long-term financial planning, considering the possibility of future rate increases. Rushing into a purchase solely based on current low rates can lead to financial strain if rates rise unexpectedly. For sellers, a period of high demand fueled by lower rates can be an advantageous time to list a property. However, it's essential to carefully evaluate market conditions, pricing strategies, and the potential for competition from other sellers. Overpricing a property in a rapidly changing market can lead to prolonged listing times and ultimately lower returns. Investors seeking to capitalize on the housing market need to carefully analyze the risks and opportunities presented by changing interest rates. Understanding the dynamics of specific local markets, the potential for price appreciation, and the impact of interest rates on rental yields is essential for making sound investment decisions.